Welcome to the Deep Dive. We pull out the core insights from complex sources so you get informed, fast. It's your shortcut to really understanding what matters.
And today, we're digging into something foundational, financial management. We're using Brigham's fundamentals of financial management, really the bedrock of how businesses, well, manage their money.
Exactly. So whether you're deep in the business world already or just curious about how companies work financially, this is definitely for you.
Our mission today is to boil down these essential ideas, maybe show some surprising links between them, and just make it all understandable.
Yeah, give you that solid grounding in financial management and why it's so relevant.
Okay, so to start wrapping our heads around this big topic,
Hmm.
how is finance generally sort of structured? What are the main areas?
Well, the book suggests thinking about it in three main parts. First, you've got financial management itself, sometimes called corporate finance.
Right.
Then there are capital markets. And finally, investments. Seeing these three pieces helps you grasp the whole flow, raising money, managing it, investing it.
That's a really helpful framework. Let's dig into each one a bit. Financial management or corporate finance, what's its main focus?
It's really about the core financial decisions inside a company. Big questions like,
Like what kind of assets should we actually invest in? Plant, equipment, that sort of thing.
and then how do we actually raise the money, the capital, to pay for those assets?
Right. And crucially, how do we run the day-to-day operations efficiently to ultimately boost the company's overall value?
It's definitely more than just profit this quarter, isn't it? It's about long-term value.
Precisely. And it's interesting that the book points out these same ideas apply even if you're not a typical for-profit company.
Oh, like nonprofits.
Exactly. Nonprofits still have to figure out how to allocate their resources, get funding, and, maximize their impact, even if it's not profit.
Interesting. Okay, so that's the internal engine. What about the second pillar, capital markets?
Capital markets. Think of them as the meeting place. They bring together the people or institutions who have surplus money, the savers, and those who need money, the borrowers, like companies.
So this is where, say, a company might sell shares of stock.
Mm-hmm. Or issue bonds, which are essentially loans.
Got it.
And these markets aren't all the same. The source mentions different types, like physical asset markets, think real estate or commodities,
Okay.
and then financial asset markets, which trade things like those stocks and bonds we mentioned. They also differ based on the maturity of the securities, short-term versus long-term.
Right. And the third area was investments.
Yes, investments. This is where we look at things from the investor side, deciding which assets to buy, how to value them.
Which ties into what we'll talk about later, like figuring out what a bond or stock is actually worth.
Exactly. Asset valuation is a huge part of investments.
Okay, let's circle back to financial management for a second. What's the main goal there? What are they trying to achieve?
For a publicly owned company, the textbook states the primary goal is generally shareholder wealth maximization.
Meaning making decisions that increase the value of the company for its owners, the shareholders.
That's the idea. But, and this is important, it's not value at any cost.
Right. The book stresses that there are boundaries,
Mm-hmm.
legal rules, ethical considerations.
Absolutely. Managers have ethical duties. The text even brings up examples like Enron and WorldCom.
Oof, yeah. Big scandals.
Big scandals with huge consequences. Company failures, people lost jobs, executives went to jail. It's a stark reminder that maximizing wealth has to happen within legal and ethical frameworks.
Yeah, definitely a crucial point. Now, you mentioned capital markets needing to be efficient. Why is that so important for the economy?
Efficient markets are vital because they help ensure that money flows to where it can be used most productively.
Meaning?
Meaning, if market prices quickly and accurately reflect all the available information, then companies with the best ideas and growth prospects should find it easiest to get the funding they need. That fuels economic growth.
Makes sense. And how does that money actually move from savers to borrowers? What are the pathways?
The book outlines three main ways. Sometimes it's direct. A company sells stock right to an investor.
Okay.
More often, it goes through an intermediary. Maybe an investment bank helps the company issue and sell securities.
Right.
Or it could be through a financial intermediary, like a commercial bank or a mutual fund, which pools money from savers and then lends it out or invests it.
Okay, so that gives us a good overview of the financial landscape. Now, let's shift gears. How do we actually measure a company's financial health? What tools do we use?
Well, the absolute foundation is the company's financial statements. And the most important report, according to the source, is the annual reports that public companies issue.
Right, that big document they send out. But it's not just numbers, is it?
No, definitely not. There's usually a verbal section, maybe a letter from the CEO talking about the year and the outlook, but the core, the real meat, is in the financial statements themselves.
Okay, like the balance sheet, what does that tell us?
The balance sheet. Think of it as a snapshot. It shows the company's financial position at one specific point in time.
What it owns, what it goes.
Exactly. Assets on one side, what it owns. Liabilities and equity on the other, what it owes to lenders and owners. The difference is the equity, the owner's stake.
And the book makes a point about book value versus market value. What's that about?
Ah, yes, that's important. The balance sheet usually shows assets based on historical cost, following accounting rules. That's book value.
Okay.
Market value is what those assets could actually be sold for today. The book uses an example like Allied's headquarters building. Its book value might be low because it was bought years ago.
But its market value today could be much higher due to real estate appreciation.
Precisely. So book value and market value can be quite different.
Okay, so balance sheet is a snapshot. What about the income statement?
The income statement tells a story over a period, usually a quarter or a year. It shows revenues coming in, costs going out, and ultimately whether the company made a profit.
So sales, operating costs, things like that.
Yep. Sales costs leading down to things like EBIT earnings before interest and taxes, then interest, taxes, and finally, the bottom line, net income.
So if the balance sheet is a photo, the income statement is more like a movie of the company's performance over that period.
That's a great analogy, and seeing both together gives you a much richer picture.
What about the third key statement, the statement of cash flows? Why is that one so important?
Ah, cash flow.
Wow.
Crucial. Because profit on the income statement isn't the same as actual cash in the bank.
Right, you can have profit, but no cash to pay bills.
Exactly. The cash flow statement tracks all the cash coming into and going out of the company from its operations, investing activities, and financing activities. And the book highlights something called free cash flow, or FCF.
Free cash flow, what's special about that?
FCF is basically the cash flow that's left over and available to all the company's investors, both debt and equity holders, after the company has made necessary investments in its operations to sustain itself.
So it's the cash generated after reinvesting in the business.
Yes. That makes it a really good measure of the value the firm is actually generating for its investors. It's considered a key driver of the firm's underlying value.
And how do changes on the balance sheet, like inventory going up, affect cash flow?
Good question. If inventory goes up, it means the company used cash to buy or produce that inventory. So that's a cash outflow on the statement.
Okay.
Similarly, if accounts receivable money customers owe goes up, the company made sales but hasn't collected the cash yet. That also impacts the cash flow calculation.
Got it. So we have these three statements. How do people actually use them to figure out if a company is doing well?
That's where financial ratio analysis comes in. It's a really powerful technique.
Ratios, like comparing different numbers from the statements.
Exactly. Managers, lenders, analysts, they all calculate ratios to assess different aspects of the firm's performance and financial condition. Things like liquidity, how efficiently assets are used, debt levels, profitability, even how the market values the company.
Can you give us a flavor of the main types of ratios?
Sure. You have liquidity ratios, like the current ratio, telling you if the company can meet its short-term bills.
Okay.
Asset management ratios measure how efficiently the company is using its assets, like how quickly it sells inventory.
Right.
Debt management ratios look at how much debt the company has and whether it can handle it.
Mm-hmm.
Profitability ratios, like return on equity or ROE, show how much profit the company generates relative to the owner's investment. And market value ratios get at the stock price to earnings or book value.
Seems like you can learn a lot, but are there pitfalls, any limitations to ratio analysis?
Oh, definitely. You have to be careful. Comparing companies across different industries can be tricky because norms vary.
Makes sense.
Inflation can distort comparisons over time, and companies might use slightly different accounting methods, which can affect the numbers. So ratios are a tool, a very useful one, but not the whole story. You need context.
Right. Use them as part of the bigger picture. Okay, we've covered the statements and analysis. Now let's shift to something the book calls absolutely fundamental, the time value of money. Why is this concept so central?
It truly is. As the source puts it, it's probably the single most important concept in finance. It underlies almost everything: personal finance, corporate decisions, valuing assets.
So the basic idea is that a dollar today is worth more than a dollar tomorrow, right? Why is that?
Two main reasons, really. First, opportunity cost. You could invest that dollar today and earn a return on it. Getting it later means you miss out on that potential earning.
Okay.
Second, inflation. Over time, prices tend to rise, so a dollar in the future might buy less stuff than a dollar today. Its purchasing power erodes.
So future money is kind of discounted compared to present money.
Exactly, which leads us straight to the core calculations: future value and present value.
Future value is figuring out what money today will grow to.
Right, through compounding earning interest on your interest.
And present value is the opposite, figuring out what a future amount is worth today.
Yeah, precisely. Discounting those future amounts back to today's value. This lets us compare cash flows happening at different times on an apples-to-apples basis.
What are the key inputs, the variables in these calculations?
There are 5 core ones. N, the number of periods; IYR, the interest rate per period; PV, the present value or starting amount; PMT, any recurring payment amount; and FV, the future value.
And if you know 4, you can find the 5th.
Generally, yes. Financial calculators and spreadsheets make these calculations pretty straightforward.
The book also differentiates annuities from single sums.
Right. A single sum is just a one-off amount. An annuity is a series of equal payments over a set period.
Like mortgage payments or lottery payouts spread over time.
Exactly. And there's a small distinction between ordinary annuities, payments at the end of the period, and annuities due, payments at the beginning.
What about a perpetuity? That sounds permanent.
It is. A perpetuity is an annuity that theoretically goes on forever, like certain types of old government bonds or some preferred stocks. It's a useful theoretical concept.
And if the cash flows aren't equal each period, like a business project with varying returns?
Then you can't use the simple annuity formulas. You have to discount each individual uneven cash flow back to its present value and then sum them all up. The book shows a timeline approach for this.
Okay. And one more detail. Nominal versus effective interest rates. Why does that matter?
Crucial for comparison. The nominal rate is the stated rate, say 10% per year. But if interest is compounded more often, like semi-annually or monthly, the effective annual rate, EAR or EFF percent, you actually earn will be higher than 10%.
Because you start earning interest on the interest sooner.
Exactly. So the EAR gives you the true annual return, considering the compounding frequency. It's essential for comparing loans or investments with different compounding periods.
And where do we see these time value concepts used constantly?
Oh, everywhere in finance. Retirement planning is all about future value. Valuing bonds and stocks fundamentally relies on present value calculations. Working out loan payments and amortization schedules uses these formulas. And maybe most importantly for companies, deciding which long-term projects to invest in capital budgeting is heavily based on discounting future cash flows.
So it really is a cornerstone. Okay, we get that money has time value.
Yeah.
Now, what about the cost of money? What determines interest rates?
Interest rates are, fundamentally, the price of borrowing money. And like most prices, they're set by supply and demand in the capital markets.
Supply from savers, demand from borrowers.
Exactly. Savers supply more capital at higher rates, borrowers demand more at lower rates. Where those curves cross gives you the basic equilibrium interest rate. Our source has a figure showing this.
But obviously, there isn't just one interest rate out there. Why do rates differ so much?
Right. Several factors layer on top of that basic rate to determine the specific rate for a loan or bond. The book breaks it down. First, there's the real risk-free rate, R star R. Think of it as the rate on a totally risk-free investment if there were zero inflation.
Theoretical, but a starting point.
Yes. Then you add an inflation premium, IP, to compensate investors for expected inflation eroding their purchasing power.
Okay.
Then comes the default risk premium, DRP. This is compensation for the chance the borrower might not pay back the loan. U.S. Treasury bonds have virtually zero DRP.
But corporate bonds have varying levels depending on the company's riskiness.
Exactly. Then there's often a liquidity premium, LP. Some bonds are harder to sell quickly without taking a price hit, so investors demand a bit extra for holding less liquid assets.
Right.
And finally, especially for longer-term bonds, there's a maturity risk premium, MRP. Longer bonds have more price risk if overall interest rates change, so investors typically want a higher return for that longer commitment.
So the actual rate we see is like R plus IP plus DRP plus LP plus MRP.
That's the conceptual buildup, yes. It shows how different risks add premiums onto that base rate.
The book also mentions the Fisher effect.
The Fisher effect just formally states that relationship between real rates, inflation, and nominal rates. Basically, the nominal rate we observe is approximately the real rate plus the expected inflation rate.
Got it. And the yield curve. That pops up in the news a lot.
The yield curve is just a graph, plotting interest rates yields against the maturity dates of bonds, typically treasury bonds.
And it usually slopes upwards. Longer maturities have higher rates.
Often, yes. And that maturity risk premium, MRP, we just talked about, is a big reason why. Investors generally demand more compensation for the extra risks of tying up money for longer.
Makes sense. Are U.S. interest rates just set domestically, or do global factors play a role?
Oh, absolutely. Global factors matter, especially things like foreign trade deficits. If the U.S. buys more than it sells, it needs to borrow from abroad.
Right.
So, interest rates in other countries and the willingness of foreign investors to buy U.S. debt definitely influence U.S. rates. It's all interconnected.
So understanding these components is vital for borrowers, lenders, investors, pretty much everyone in finance.
Absolutely. The cost of money feeds into so many other calculations and decisions.
Okay, so we know about the cost of money. Now let's talk about investing that money, specifically in financial assets like bonds and stocks. Starting with bonds, what are their key features?
Right. Bonds are essentially IOUs issued by governments or corporations. Key things to know. The par value, that's the face amount repaid at the end.
Usually $1,000 for corporate bonds.
Commonly, yes. Then the coupon interest rate that determines the regular interest payments the bondholder receives.
Okay.
The maturity date tells you when the par value gets repaid. And some bonds have extra features like call provisions.
Which let the issuer buy the bond back early.
Exactly, often if interest rates fall. And sinking funds, which are arrangements to pay off the debt gradually over time.
So how do you figure out what a bond is actually worth today?
It comes back to that core principle. Present value. A bond's value is the present value of all the future cash flows it's expected to pay.
Which are the coupon payments and the final par value repayment.
Precisely. You discount those cash flows back to the present using an appropriate discount rate, usually the investor's required rate of return, often called the yield to maturity, YTM.
You mentioned yield to maturity. The book also talks about yield to call, YTC. What's the difference?
YTM is the total return you'd expect if you hold the bond until it matures. YTC is the return you'd expect if the bond gets called before maturity. You'd calculate YTC if a bond is callable and interest rates have dropped, making a call seem likely.
Makes sense. What are the big risks when investing in bonds?
Two main ones highlighted in the source: interest rate risk and reinvestment rate risk.
Okay, interest rate risk is.
That's the risk that if overall market interest rates go up, the market value of your existing bond with its lower fixed coupon rate will go down. Longer maturity bonds have more of this risk.
Got it. And reinvestment rate risk.
That's kind of the opposite problem. It's the risk that if market interest rates go down, when you get your coupon payments or your principal back at maturity, you'll have to reinvest that money at lower rates than you were getting before. Shorter-term bonds and high-coupon bonds face more of this risk.
Interesting how they work in opposite directions. Okay, that's bonds. Let's switch to stocks or common stock. What's the deal there?
Common stock represents actual ownership in a company. Owning stock usually gives you voting rights.
To elect the board of directors, right?
Yeah.
Who then oversee management.
Exactly. The book also briefly mentions preferred stock, which is sort of a hybrid. It has features of both debt, fixed payments usually, and equity.
How do we approach valuing stock? It seems trickier than bonds, with less certainty about cash flows.
It definitely involves more uncertainty. The key concept is intrinsic value, trying to estimate the true underlying worth of a stock. This is usually based on the present value of the cash flows the stockholder expects to receive.
And for stocks, that's primarily dividends.
Primarily dividends, yes, or the potential future selling price, which itself depends on expected future dividends. The market price might fluctuate around this intrinsic value, but the idea is they should converge towards equilibrium.
The book talks a lot about the discounted dividend model, DDM. How does that work?
The DDM formalizes that idea. It says the value of a stock today is the present value of all future dividends the company is expected to pay, discounted back at the investor's required rate of return.
Okay. Is there a simplified version?
Yes, if you assume dividends will grow at a constant rate, G forever, the math simplifies nicely. The formula becomes price, POG, equals next year's dividend, D1, divided by required returners minus the growth rate, G. PZ always D1.
A constant growth DDM. But what if growth isn't constant? Like for a young, fast-growing company?
Good point. For non-constant growth, you have to do it in stages. You forecast the dividends during the high growth phase, calculate their present values, then estimate when growth will level off to a constant rate, calculate the stock's price at that future point using the constant growth model, and discount that price back to the present too. Add all the PVs up.
Sounds more involved.
It is. The book also mentions an alternative, the corporate valuation model or free cash flow approach. Instead of dividends, it values the entire firm based on its free cash flows, then subtracts debt to get the equity value.
Interesting. So different ways to estimate that intrinsic value.
Yes, reflecting the inherent uncertainty in forecasting the future.
Okay, we can't discuss investing without tackling risk and return directly. What are the fundamentals there?
Well, the basic principle is that investors expect to be compensated for taking on risk. Higher risk should come with the potential for higher returns.
How do we measure return and risk?
Expected return is usually thought of as a weighted average of possible outcomes. Risk is about the uncertainty or variability of those outcomes, often measured statistically by standard deviation. More variability means higher risk.
And most investors are risk averse,
Yeah.
right? They don't like uncertainty.
Generally, yes. That's why there's a risk premium. Investors typically demand a higher return for investing in risky assets compared to risk-free assets like treasury bills.
Can investors do anything to manage risk? Is that where diversification comes in?
Exactly. Diversification, holding a mix of different assets, is incredibly powerful. It can significantly reduce risk without necessarily sacrificing expected return.
How does it work?
By combining assets that don't move perfectly together, the ups and downs tend to cancel each other out to some extent. It drastically reduces diversifiable risk, which is risk specific to a single company or industry.
But it can't get rid of all risk.
No. It can't eliminate market risk, also called systematic risk. That's the risk tied to broad economic factors that affect almost all companies, like recessions, changes in interest rates, etc.
And beta is the measure of that market risk.
Yes, beta measures how sensitive a stock's return is to movements in the overall market. A beta of 1 means the stock tends to move with the market. Greater than 1, more volatile. Less than 1, less volatile. It captures that non-diversifiable systematic risk.
Okay, so how does beta help determine the return an investor should require for holding a particular stock?
That brings us to the capital asset pricing model, the CAPM. It's a cornerstone model in finance.
CAPM, what's the formula?
The CAPM says the required return on a stock, RS, equals the risk-free rate, RRF, plus the stock's beta times the market risk premium, which is the market return RM, minus the risk-free rate RRF. So RSRF plus BRM RRF.
So the required return depends on the risk-free rate, the stock's specific market risk, beta, and the overall compensation for market risk.
Precisely. It provides a theoretical link between risk and expected return. The security market line, SML, is just the graphical representation of the CAPM.
Got it. That connects a lot of dots. Okay, let's move on to how companies actually get the money for all these investments, raising capital, and importantly, the cost of that capital.
Right. Companies need funds to operate and grow. The two main sources are debt borrowing money and equity selling ownership stakes.
And understanding the cost of this capital is crucial, which leads to WACC.
WACC, the weighted average cost of capital. Yes, a very important concept. It represents the blended average cost of all the different types of financing a company uses.
Why is it so important?
Because it's typically used as the benchmark, the hurdle rate for evaluating investment projects. A project should generally only be accepted if its expected return is higher than the WACC. Otherwise, it's not adding enough value to compensate the investors providing the capital.
So how is WACC calculated? What goes into the weighted average?
You calculate the cost of each individual capital component debt, preferred stock, if any, and common equity, and then you weight each cost by its proportion in the company's target capital structure.
Let's break that down. Cost of debt.
That's the interest rate the company pays on its new debt. But since interest payments are usually tax deductible, we use the after-tax cost of debt in the WACC calculation, or D-Day, 1-T, where T is the tax rate.
Okay. Cost of preferred stock.
That's typically the annual preferred dividend divided by the net price the company receives when issuing it.
And the cost of common equity, RGAS. That seems like the trickiest one.
It can be. There's no fixed payment like with debt. The book discusses 3 main ways to estimate it.
Which are?
One is using the CAPM we just talked about. Another is the bond yield plus risk premium approach, basically taking the company's cost of debt and adding a subjective risk premium.
Okay.
And the third is the discounted cash flow, DCF, or dividend yield plus growth rate approach, based on the DDM formula rearranged to solve for the required return. Companies often look at all 3 to get a reasonable estimate.
And is the cost different if the company uses retained earnings versus issuing new common stock?
Yes, slightly. Issuing new stock involves flotation costs, fees paid to investment banks. These costs make the cost of new common equity slightly higher than the cost of using retained earnings.
Got it. You mentioned target capital structure in the weighting. What is that?
That's the mix of debt, preferred stock, and common equity that the company aims to have over the long term. Management tries to find the mix that minimizes the overall WACC, which should theoretically maximize the firm's value.
What factors influence that target mix?
Things like the company's business risk, its tax position, since debt interest is deductible, its need for financial flexibility, management's attitude toward risk, lots of factors.
And finally, breakpoints in the cost of capital. What causes those?
Breakpoints happen when the cost of one of the capital components changes. For instance, a company might exhaust its cheaper retained earnings and have to issue more expensive new common stock. Or taking on significantly more debt might increase the interest rate it has to pay. These increases cause the overall WACC to jump up at certain levels of new financing.
So the WACC isn't necessarily constant as a company raises more and more money.
Exactly. Understanding these breakpoints is important for planning large investments.
Okay, understanding the cost of capital is clearly vital for deciding where to invest it, which brings us neatly to capital budgeting, deciding on those long-term investments.
Right. Capital budgeting is the whole process of analyzing potential long-term projects, usually involving large expenditures on things like new machinery, new facilities, new technology, and deciding which ones to undertake. These are often strategic decisions.
What are the main techniques companies use to evaluate these projects? You mentioned WACC as the hurdle rate.
Yes. The most conceptually sound method, according to the source, is net present value, or NPV.
How does NPV work?
You forecast all the future cash inflows and outflows the project is expected to generate over its life. You discount all those cash flows back to their present value using the project's appropriate risk-adjusted cost of capital, often starting with the WACC. Then you subtract the initial cost of the project.
And the decision rule.
If the NPV is positive, the project is expected to add value to the firm, so you accept it. If NPV is negative, reject it. If it's zero, you're indifferent, theoretically.
Seems logical. What about the internal rate of return, IRR? That's often mentioned too.
Oh, IRR is another popular method. It calculates the discount rate at which the project's NPV equals exactly zero. So it's essentially the project's expected rate of return.
And the rule for IRR.
You compare the IRR to the cost of capital, WACC. If the IRR is greater than the WACC, you accept the project.
Are there any issues with IRR?
Sometimes. For unconventional projects with weird cash flow patterns, you might get multiple IRRs, which makes the decision rule ambiguous. And for mutually exclusive projects, IRR can sometimes give a different ranking than NPV, and NPV is generally preferred in those cases.
What about simpler methods, like the payback period?
The payback period just calculates how long it takes for the project's cash inflows to recover the initial investment cost. It's easy to understand and gives a sense of liquidity risk, but it ignores the time value of money within the payback period and completely ignores any cash flows after the payback period. So it's generally seen as a weaker secondary measure.
The book really stresses getting the cash flow estimates right for these techniques. What's involved there?
That's often the hardest part. You need to estimate the initial investment outlay, the operating cash flows the project will generate each year, and any terminal cash flow at the end of the project's life, like salvage value.
And it's about incremental cash flows, right? The change caused by the project.
Exactly. What are the company's cash flows with the project versus without it? You need to ignore sunk costs, money already spent. But you must include opportunity costs, like using land you already own that could have been sold, and consider externalities, like if the new project impacts sales of existing products.
And how does risk factor into capital budgeting? Projects aren't guaranteed.
Right. Risk analysis is crucial. The source talks about different types of risk. Standalone risk, the project viewed in isolation. Within firm risk, how it affects the company's overall risk. And market risk, how it affects the company's beta.
How do they assess standalone risk?
Techniques like sensitivity analysis, changing one variable at a time, scenario analysis, looking at different plausible outcomes like best case, worst case, and Monte Carlo simulation, using computers to run thousands of scenarios, are used.
And how do they adjust for risk in the decision?
One common way is to use a risk-adjusted discount rate. Riskier projects get evaluated using a higher discount rate, higher than the base WACC, making it harder for them to achieve a positive NPV.
Are there other ways to manage risk?
Yes, incorporating real options thinking can be valuable. This recognizes that managers often have flexibility, like the option to abandon a project if it performs badly, or expand it if it does well. Decision trees can help analyze these sequential decisions under uncertainty.
Okay, so that covers big long-term investments. What about managing the short-term stuff? Working capital management.
Right, working capital is about managing the company's current assets and current liabilities efficiently. Current assets are things like cash, accounts receivable, inventory. Current liabilities are accounts payable, accruals, short-term loans.
And working capital itself is current assets minus current liabilities.
Net working capital, yes, but working capital management is about managing each of those components effectively. It's vital for day-to-day survival
Why is it so critical?
because it directly impacts the company's liquidity, its ability to pay bills as they come due. Poor working capital management can lead to cash shortages, even bankruptcy. But holding too much working capital, like excessive inventory, ties up funds that could be invested more profitably elsewhere. So it also affects risk and profitability.
The book mentions different policies for managing current assets.
Yes, broadly speaking, a relaxed policy means holding lots of cash, inventory, and being generous with credit, low risk, but maybe lower profitability. A restricted policy means keeping current assets lean, potentially higher profit, but more risk of shortages or running out of cash. And moderate is somewhere in between.
And how companies finance these current assets also matters.
Yes. A maturity matching approach tries to finance temporary current assets with short-term debt and permanent current assets with long-term financing. Aggressive policies use more short-term debt, riskier but potentially cheaper, while conservative policies use more long-term financing, safer but potentially costlier.
The cash conversion cycle sounds important here. What does that measure?
It measures the average time from when a company pays cash for its raw materials until it receives cash from selling the finished product.
So how long cash is tied up in the operating cycle?
Exactly. Shorter is generally better. It's made up of the time inventory sits around, the time it takes to collect receivables, minus the time the company takes to pay its own suppliers. Payables deferral period.
How do companies manage specific things like inventory?
Inventory management is a balancing act. Holding too much ties up cash and risks obsolescence. Holding too little risks stockouts and lost sales. Companies use various models to try and find the optimal level.
And accounts receivable, managing money owed by customers.
That involves setting the credit policy, who gets credit, how much, for how long, and then having effective collection procedures to make sure customers pay on time.
And if companies need short-term funds themselves, what are common sources?
Bank loans are very common, things like lines of credit or revolving credit agreements. Trade credit delaying payment to suppliers is another major source. The cost of these varies, and it's important to look at the effective cost, not just the stated rate.
Okay, shifting from short-term management to looking further ahead. Financial planning and forecasting. What's the main purpose?
It's about setting goals and charting a course to reach them. It starts with the company's overall strategic plan, its mission, scope, objectives.
And the sales forecast is key.
Absolutely. The sales forecast is usually the starting point for almost all other financial plans and budgets. Getting it reasonably accurate is critical.
How do forecasts help figure out future funding needs? The AFN equation.
Right. The additional funds needed, AFN equation, is a simple tool for a first-pass estimate. It forecasts how much external financing, debt or equity the company might need to support a projected level of sales growth based on how assets and liabilities typically grow with sales and considering profit margins and dividend payouts.
But assets don't always grow perfectly in line with sales, right? Like fixed assets.
Good point. If a company has excess capacity, its fixed assets might not need to increase immediately even if sales go up. So forecasters need to consider capacity utilization and the target ratio of fixed assets to sales for more accurate projections.
And the end result of all this forecasting is usually projected financial statements.
Exactly. Pro forma statements, projected income statements, balance sheets, cash flow statements. These help managers see the expected financial consequences of their plans, identify potential problems or funding gaps, and evaluate different strategies.
Finally, the world is global. What about international financial management? What makes it different?
Multinational corporations, MNCs, operate in multiple countries, seeking new markets, resources, efficiencies, knowledge. Lots of reasons.
But it adds complexity compared to just domestic operations.
Definitely. Big differences include dealing with multiple currencies and fluctuating exchange rates.
That seems like a major one.
It is. There's also political risk, the risk of adverse government actions in foreign countries. Different legal systems, tax laws, economic conditions, cultures, languages, all add layers of complexity.
Exchange rates themselves. How are they determined? Fixed versus floating.
Historically, some systems tried to fix exchange rates. Today, most major currencies operate under a floating system where rates are primarily set by supply and demand in the foreign exchange markets, though central banks might intervene sometimes.
What influences those supply and demand forces?
Things like relative inflation rates between countries, interest rate differences, trade balances, government policies, and general economic and political stability or instability.
Do MNCs use international capital markets?
Yes, they often raise money globally, which can offer more options and potentially lower costs, but also exposes them to managing international interest rates and exchange rate risk on their financing.
And the book mentions country risk. What's that?
Country risk is a broad term covering all the risks associated with operating in a specific foreign country: political risk, economic risk like recessions or hyperinflation, transfer risk, difficulty getting funds out of the country. MNCs have to assess this carefully when deciding where to invest.
Wow, okay. We have covered a massive amount of ground, from the basic goals to global complexities. If you had to boil it down, what are the absolute key takeaways from this deep dive?
I think it comes down to a few core ideas. First, finance is about creating value, usually shareholder value, but within ethical and legal bounds. Second, financial statements are the language we use to measure performance, and ratios help us interpret that language.
Mm-hmm.
Third, the time value of money is everything a dollar today isn't a dollar tomorrow. Fourth, capital has a cost, WACC, and investments need to earn more than that cost. Fifth, asset value comes from expected future cash flows, discounted for time and risk.
Right, risk and return are linked.
Inextricably linked. Diversification helps manage some risk, but not market risk, beta. You need tools like CAPM to think about required returns. And finally, managing short-term assets and liabilities, working capital, and planning for the future are essential for survival and growth, especially in a global context.
So what's the big aha moment for someone listening, trying to piece this all together?
The real aha is seeing how these pieces connect. They aren't separate topics. Time value impacts WACC, which impacts capital budgeting. Stock valuation uses risk concepts from CAPM. Financial statements feed ratio analysis, which informs planning. It's a whole interconnected system for making smart decisions about money.
So understanding these fundamentals gives you a framework, a way of thinking.
Exactly. It empowers you. Whether you're looking at your own retirement savings, analyzing a company's stock, or making decisions inside a business, these principles provide the toolkit and the mindset to do it more effectively.
And if this discussion sparked interest in a particular area, where should listeners go next?
Well, obviously, going deeper into the source material itself, Brigham's book is a great start for more detail on any of these topics. Beyond that, there are tons of resources, other textbooks focusing on specific areas like investments or corporate finance, reputable financial websites, academic journals if you're really keen.
Plenty to explore further. Okay, to wrap up, here's a final thought provoker for our listeners, building on what we've discussed.
Okay, let's hear it.
Considering the fundamental principles of financial management we've discussed, how might a small, privately held business approach capital budgeting decisions differently than a large, publicly traded corporation?
That's a good one. Lots to think about. The different goals, access to capital, risk tolerance. Definitely something to ponder.
Indeed. Well, thank you for joining us on this deep dive into financial management fundamentals.
My pleasure.
Until our next exploration, keep diving deeper.